Good morning and welcome to this Monday, January 3rd, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. First of all, Happy New Year, everybody. 2022 is now underway. Hard to believe. Another year under our belt. But we'll see what 2022 holds. I mean, we're going in still with a lot of talk about the coronavirus. This is now year 3. Of course, we've been through 2020, 2021 with the original COVID-19, the variants. We go into 2022 with the fast spreading Omicron variant. So going to be another interesting year for sure to see how all this plays out. I continue to believe that we have a healthcare crisis that we have to continue to monitor, but it is not a financial crisis. And I think that's been proven out over the last couple of years. Couple of things as we get started today. I'm going to go through and give you last Friday's performance. It was pretty typical. I was a little nervous going through the Santa Claus rally. Wasn't sure we'd see one this year, but the market did do what it typically does, which is mostly move higher. It wasn't a huge week, but we did see mostly higher prices last week. So we'll go through, we'll take a look at what happened on Friday. I'm going to spend some time talking about 2021, in the rearview mirror, some of the things maybe that we need to keep in mind as we go into 2022. And then I'm going to spend some time today talking a little bit about our portfolios at Earnings Beats. Had an interesting email from a member. Our portfolios are mostly growth oriented, and growth oriented stocks, if you weren't in the largest of the growth stocks, the Apples, the Microsofts, and so forth, most of the growth stocks did not perform well on a relative basis in 2021. So there were questions about what we might expect in 2022, especially if you've been reading some of my articles. I've been a little bearish of late. It's not that I'm long-term bearish. I'm still as long-term bullish as ever. But I do see more and more warning signs in the near term that we have to be careful. And so the question that came up was, what do we do with the portfolios in the short term, given the prospects of potentially rocky market ahead? And so I'm going to spend some time talking about that, talking about the philosophies behind these portfolios. Maybe some of you who are members with Earnings Beats don't have the history and don't have some of that knowledge. I think that would be important. And then many of you who are maybe non-members of Earnings Beats might get something out of these portfolios and really what we're trying to do with these. So I figured going into 2022 and new year, this would be a great time and a great subject to bring up. So that's what we're going to do today. Again, I want to wish everybody a happy new year. Hope everyone was safe over the holidays. I was able to get away for a week, went down to Florida last week. Didn't really do a whole lot in terms of reports for Earnings Beats. I think I did send out one daily market report last week. I did more abbreviated versions of the weekly portfolio reports both weekends. I don't think I gave any individual charts of stocks within the portfolio. So a little abbreviated, but it was not a week off entirely for me. I tend to do these workations where just kind of still thinking ahead. One of the things that I did last week was, I updated all of the S&P 500 stocks, all of the NASDAQ 100 stocks regarding seasonality. So I've got all of that now on a spreadsheet. I think the companies that make up both of those indices, there's probably about 530 or 540 of them. So I went through, updated all of those average monthly performance, all that data for those 530 some companies. So it wasn't completely a vacation week, although I did get out and play some golf in some nice weather last week. So that was good. And I actually played some pretty good golf, so I was pretty happy. But now it's time to get back to the grind here. We got the market opening up a new year here in about 25 minutes. So let's jump into some of the things I think we need to talk about today. First thing, if you are new to Earnings Beats, I'm going to start this off like I start off every webinar. or every show, you need to go to earningsbeats.com. And what I would do is, if you want to learn something about us and find out what we're all about, just subscribe to our Earnings Beats Digest newsletter. It's a free newsletter, no credit card required. You can unsubscribe at any time, but it does come out 3 times a week. This morning, I had a pretty timely article out on Netflix and how Netflix tends to perform extremely well in the first quarter of calendar years. Doesn't happen every year. I always like to throw that caveat out there. Nothing is a guarantee. Nothing is a guarantee. I can give you my opinion all day long, but I can promise you the one guarantee I can make you is I'm going to be wrong from time to time, for sure. But maybe if we have some time, I'll take a look at that Netflix chart. Maybe we'll try and do that early in the show. But anyway, Monday, Wednesday, and Friday, we come out with these articles. I publish them. They're very quick reads, typically 2 paragraphs in a chart. So you can grab your morning coffee, look at it probably in about 3-4 minutes max, and be able to get a pretty good sense of some of the things that we think are important at Earnings Beats. But definitely go to earningsbeats.com and scroll down to this box here. All it takes is a name and an email address. Again, it's free, no credit card. Great way to learn more about the market and learn more about us. Moving on to the action from Friday, I'm not going to spend much time here. We did see the market reverse late in the day. So the Dow finished down 60 points. The S&P was down 12.5. The NASDAQ down 97. Mid caps, though, did finish up slightly, up 3 points. Small caps relatively flat. We ended the year with staples leading the action on Friday, up about 2/3%. Materials up a little bit more than 0.4%. Industrials, same, roughly 0.4%. To the downside, communication services, which had a very rough fourth quarter, finished it off by losing 1.38%. And then technology, which held up pretty well, mostly because of a couple of those big cap names. That's and you'll see what I'm talking about in a couple minutes. But technology did finish down 0.5% on Friday, so it was the second worst performing sector. The 10-year Treasury yield, we wrapped up last week and the year at 1.51%, which is interesting because back in the end of February and March, when we started seeing all the inflation talk, all those inflation numbers really start to kick in. At the end of February, we were sitting at about 1.5%. So throughout the entire year, with inflation spiraling higher and the Fed telling us all these rate hikes are coming, throughout it all, the bond market's been flat. I happen to think the bond market is a lot smarter than the stock market. For whatever reason, I think there's a lot of manipulation that takes place in the stock market. There's there's money at stake in both markets, but I think from the volatility that we see in the stock market, there's no question in my mind that there's a lot more money at stake in the stock market. And so I don't think you can always believe what you're seeing on the stock charts. But when it comes to the bond market, this is more of an allocation. A lot of portfolio managers trying to decide, okay, do I want to go into bonds? Do I want to go into stocks? What's my allocation going to be? Well, if you're really worried about inflation, I would be buying a lot more bonds, and I'd be selling a lot more bonds. The yields be rising. I wouldn't want to hold bonds in an inflationary environment. Why? Because if you're holding a bond that's yielding 1.5%, and inflation is rising, you're losing money. If inflation is above 1.5%, you're actually losing money. I mean, it gives you safety. You're going to get your principal back. So there's still some reason to be into bonds, but you're going to lose money in an inflationary environment. So for me, that would be reason to move out of bonds. If anything, move into cash, even if I didn't want to move into the stock market. Anyhow, we're not really seeing that. So the bond market, to me, is acting as if inflation, this spike, is going to be temporary. And that's what I believe. But I don't necessarily know that that's going to translate that way into the stock market. And that's one of the things that bothers me heading into 2022 as we move in. Anyway, right now you got the 10-year Treasury yield at 1.58. So today it's up 7 basis points this morning. That should bode pretty well for financials and industrials this morning. I know we've got futures up pretty nicely. And one question I know that's come in has asked me, what would it take for me to move away from my short-term or intermediate-term bearish stance that I'm starting to build? Well, one thing is I just want to see money rotate back to aggressive areas. So if the 10-year treasury yield is going up, that means money's coming out of the bond market. So that already is telling us that money is maybe going to be a little bit more aggressive if that money finds its way into the stock market. At least at the open, it looks like it will. So what I want to see, there's this thing that's called the January effect. If you're not familiar with it, the January effect is essentially the better the stock market does in January, historically, the better it does from February to the end of the year. You might think, well, if the stock market only goes up 9% a year on average over the last 7 decades, and it goes up 5% in January, that means the rest of the year is only going to get like 4%. So it's not really worth being in. That is not the way the stock market works. If the S&P 500 were to climb 5% in January, the odds of going up at least 10% or more the rest of the year, not including that 5%, but I'm talking about from February 1st to December 31st, the odds of the S&P going up another 10% are much, much higher. That's the January effect. That a lot of times the saying is, as January goes, so goes the year. And so I'd like to see the market get off to a good start. Remember, we got quarterly earnings starting in a couple of weeks. So normally we see these pre-earnings run-ups. Now, I think what could happen is we could see a good January with earnings, but February and March tend to be a little bit weaker, especially once you get past the first half of February. That period can be very challenging. And that's also going to be the period when we have a lot of key inflation data coming out and likely continuing to signal this inflation surge that seems to not be letting up right now. So you get past earnings season and then move into a period when the market doesn't do as well to begin with. Throw in the inflation, throw in the tapering of the Fed. And some of these things I think could have an impact, a big impact later in the first quarter. Now, we might start off weak. I'm going to see what happens. But I mean, for me, I want to see the market strong as we open up January historically. And that's the thing, there's so many things I look at. I can look at the daily charts. I can look at the 60-minute charts. They could tell me two different things. 60-minute charts might be showing negative divergences. The daily charts might be looking great. And then, you might go into the year like we are right now. The weekly charts on our major indices have negative divergences. That's bearish. But we're in one of the most bullish, well, not one of the most, we are in the most bullish historical period of the year, from the close on October 27th to the close on January 18th. So we still got a couple more weeks of that. So if you want to be bearish, there's plenty of things to find to support your bias. And I think that's what Dave Keller over Stock Charts refers to as confirmation bias. If you believe the stock market's going lower, you can always find something to support that bias. If you think the stock market's going higher, you can always find something to support that bias. To me, it's about gathering all the evidence, the mountain of evidence, and trying to make a more educated guess based on everything. And still, I say it's a guess. It is not fact. It's not a guarantee. It's not something that, I would hang my hat on and say, this is what the stock market's going to do. Because quite honestly, the market can do anything it wants to do. I could see every bearish signal lining up perfectly and the market can still go higher, climb that wall of worry. But I think as you see more and more bearish signs, you have to recognize the increased risks that are associated with those signals. And that, in a nutshell, is what I'm going to be talking about on Saturday. I do believe the first half of 2022 could be very challenging. But I also believe the second half of 2022 could be one of the biggest rallies that we've seen in this secular bull market. So there's the tale of two markets perhaps in 2022. And I'm going to be talking about why, the things I'm looking at, all those things are going to be out on Saturday when we have our Market Vision 2022 event. I mentioned Dave Keller. He's the host of the Final Bar, the chief market strategist of Stock Charts. He's going to be joining me on Saturday. Grayson Rose, vice president of operations at Stock Charts. Many of you know Grayson. He'll be joining me on Saturday. And then I got another special guest from Stock Charts, Bill Shelby, who is the lead software engineer. He created the scan engine. Bill and I are going to have a joint session on Saturday, and we're going to talk about what we do at Earnings Beats, and Bill's going to give us his thoughts on some of the ways that you can use the powerful scan engine at Stock Charts. All of this, by the way, is free to all Earnings Beats members. So if you're not a member, this would be a great time to take out a 30-day trial. So if you're at Earnings Beats, I'll just show you this real quick, but just go in here, start your no-cost trial. You can read through many of the things we do. We have a lot of information that we provide at Earnings Beats. It's not just our portfolios. It's not just the shows. It's not just the daily market report. You can go through. There's a ton of information. Anyhow, click on that button to join today, and you can get a 30-day free trial. And that's all it takes to be able to come to Saturday's event. And I think you're going to find a lot of value in Saturday's event. But anyway, that's that. Let's move on. So the S&P 500. Here it is. This is 2021 in a nutshell. How many thought with the pandemic still a problem? COVID cases still surging and so forth. We did just have the vaccine news come out. I think it was in early November of 2020. But who thought going into 2021 that we would see this kind of rally? Well, I can tell you I did, and it was documented at the Market Vision 2021 event, which was held right back here. My prediction of the S&P 500 at the end of 2021 was 4,750. We finished at 4,766. Pretty close. And I don't pat myself on the back very often, but I think that was a pretty good call. I also said that the most difficult part about 2021 was going to be rotation. And I think it's pretty clear that that was the most difficult challenge. The biggest challenge that we had was trying to figure out not whether the S&P 500 was going to go higher. It was persistently higher throughout much of the year. But what was going to lead? Where was the money going to go? And if you made the bet back at the beginning of the year that it would be the large cap growth stocks, you did extremely well. If you thought that energy was going to bounce back, you did extremely well. If you thought that small caps were going to lead, mid caps were going to lead, it was a different story because they didn't. They struggled. This is the S&P 500. If we look at the small cap index, you can see from March, middle of March, we were at 1,400. We closed at 1,400. I mean, small caps really did nothing over the last 9-10 months of the year. Completely sideways. Got a breakout in November. Looked like we were going to do something. And as many of you that are Earnings Beats subscriber knows, I mean, when we did our event back in November to pick our new portfolio stocks, this breakout in small caps was one of the reasons why we put more small cap growth stocks into our portfolio. Mid cap, same thing. We pull up mid cap index, so mostly sideways consolidation. November, we break out. So when we pick November 19th, we're looking at continuing strength in small and mid caps. What happens? Small and mid caps both have struggled. So, and it's not just that they've struggled. I'll show you some charts coming up shortly. It's the relative strength of value stocks versus growth stocks that took over. So, the overall index may have been flat for the last, maybe 6 weeks or so, 5-6 weeks, but the shift back toward value was very evident in many of the charts. And so that is something that I'm going to talk about here in a second. The sector summary, here it is for the year. So there's your energy, real estate, financials. Those were your
Hey, Tom. I'm so sorry to interrupt. I just stepped back to the computer and your screen is not showing.
Wow. It's showing on my end that it's showing. Hold on. I'll tell you what I'll do. I'll cancel it out. I'm really sorry. We've been doing this for a while now. But I haven't really looked at too many charts, so it's probably not that big a deal. But let me I don't know why. Get New Year start off in a, oh, there we go. Okay, so let me try this here. Is that better, Aaron?
Yes, we have it now. Thank you.
All right. Thank you. All right. So I apologize. I'll just go real quickly. Here was the detail from what happened on Friday that I was looking at. Again, not really a whole lot. I just wanted to point out maybe that the XLC, I think I said there, the last 3 or 4 months of the year were rough. You can see that. Staples actually been very strong. Materials, industrials, these are more value oriented stocks. And that's what I was just talking about, that this last rally here that we've seen to the upside has really been led more by value. And that's why, even though small caps have been flat, mid caps have been flat. And here were the charts I showed there. Here was the mid caps going sideways, breaking out, and then coming back down. If I go back here, I can show you the small caps going sideways. There's that breakout in November. So this is what we were looking at on November 19th with our portfolios. We had small caps and mid caps breaking out of sideways consolidation. So we went with our small and mid cap growth stocks. And as I was just talking about back here with the summary from Friday, you can see here, look at staples in December and really since November. Materials breaking out, industrials kind of hanging in with where they've been. Then when you look at the more growth-oriented communication services, this has been down. Technology's gone up, but as you'll see, it's mostly the large caps. So all of these things have kind of contributed to the rotation that I was talking about in the market. So, 2021 wasn't as much, in my opinion, about whether the market was going to go higher or not. It was really more about the rotation. And that was the difficult part of assessing the market in 2021 in trading, trying to be in the right area at the right time. Because when the inflation news started surging February to May of last year, the growth stocks absolutely got crushed. And then just when you think the growth stocks can't possibly do well, with rates really not coming down much, growth stocks took back off again. And so it's been very difficult to try and negotiate the themes that permeated the stock market, the US stock market in 2021. Now, here I was just talking about the sectors and the yearly performance. Here you go, energy, real estate, financials. These were your top 3. Technology didn't do bad, but it was mostly the large cap names that drove technology. Same goes with consumer discretionary, maybe not quite as much. We did see some of the others, mid caps in that area do a little bit better. But in technology, it was a lot of it was about Apple and Microsoft, which both had very good years. Anyway, when we look at the energy, we didn't really do much with energy, but I'm not overly concerned about that because we haven't done much with energy for 10 years at earnings beats. And if you look at the long-term chart on energy relative to the S&P 500, I'll give up the periods of energy when it bounces as it did this year if I can avoid all of this carnage that we've seen since all the way back in 2008, really started kicking in about 10 years ago in 2011. So as long as I believe the dollar goes higher, I'm going to tend to be very bearish on a relative basis energy. Now, could energy go higher in 2022? Absolutely. I mean, look how beaten up it's been. But I still believe it's in a relative downtrend. I think the reason that we saw such a strong 2021 is because we saw such a horrendous 2020. I mean, think about a stock that goes from 50 to 5 and then bounces back to 10. Does that make you feel great about the stock because it went from 5 to 10? It doesn't me. And that's the way I think if you look at the big picture, that's really what happened with energy. If you remember, crude oil prices went negative. If you had an empty swimming pool, you could be paid to store crude oil. That's how bad energy prices were during 2020, during COVID. Nobody wanted to buy energy, crude oil. There was little demand and a tremendous amount of supply. And so as demand started to ramp back up in 2021, we came out of ridiculous levels of crude oil back to more normal levels. And as a result, energy stocks have bounced. Do I think this continues in 2022? Do I think energy is going to be the leading sector in 2022? I do not. I would not put a dime on that. But I've been saying that throughout 2021. And you can see energies continue to do well. But again, I'm taking a look at the big picture. I'm looking at the dollar. I'm looking at a lot of different things. Would I diversify and still have some in energy? Well, it depends on each person's style. If you like to diversify and you need to diversify, then yes, absolutely do it. But for me, I'm trying to outperform the S&P 500. I don't think energy is going to be a leader in 2022. And so for me, I'm not going to be interested, even though, or if I was interested, let's look at the energy chart, the absolute chart for a second. I mean, you can see we've been kind of moving higher highs, higher lows. I would just be careful if it starts to roll back over and starts to break down on the daily chart, because we know what the long-term weekly relative weakness looks like. So if the daily chart starts to break down, all bets would be off for me for energy. All right, so let's talk a little bit now about the portfolios. I'm going to probably go a little over 9:30 because I want to spend about 10 minutes on this. One of our members wrote in and asked, if I'm bearish going into 2022 and the growth stocks, many of the portfolios are down for 2021 relative to the S&P 500. What does that, how does that bode for these portfolios as we go into 2022? Because small and mid cap stocks haven't performed as well already, will they no longer be the stepchild? Will they come back? And will it be more about the large cap going down? Well, let me say I don't have a crystal ball, so I don't know the answer to that question. What I do know is a couple of things. Number one, I think that there are risks that are increasing for the stock market in general, but particularly for growth stocks. That might mean that Apple and Microsoft both come down considerably in the first half of the year. It might mean that they don't pay any attention, they keep going higher. I mean, again, the risks are increasing, but whether or not it actually, leads to significant selling, that remains to be seen. I mean, as I mentioned earlier in the show, if the market takes off in January and growth and technology and all these stocks all suddenly catch fire again, a lot of these warning signals will be eliminated. So, we can't just make a call and then ignore everything else that happens. That's point number one. We've got to see what happens in January. Now, if the market starts going down in January, especially the beginning of January, when historically it's done very well, then I think that's going to add on to some of the worries that I have right now heading into the beginning of the year. As far as our portfolios go, the thing that I think is most important about our portfolios, I think everyone has to understand, we live in the moment when it comes to the stock market. And honestly, we don't do ourselves any favors at earnings beats because we focus on quarterly performance of the portfolios, which is really, we switch out the portfolios every 90 days. And that's why the focus is on the quarterly performance. But if you think about being in a long-term secular bull market, and you think about growth stocks, I mean, growth stocks have crushed value stocks over the last 10 years. I mean, that's not my opinion. That's a fact. When we're in a secular bull market, growth stocks tend to significantly outperform value stocks because earnings grow rapidly and growth stocks are the ones that benefit from that higher growth. The thing about our portfolios is that they are buy and hold. And I think that confuses a lot of our members, and I don't really know, other than talk about it frequently, how to really describe these portfolios and the themes and so forth, that lead to their outperformance and underperformance over periods of time. These portfolios, I consider long-term. I consider if you want to get into our portfolios, you really should have that long-term buy and hold mindset. And I think what happens is that we get a lot of traders who look at our performance in these portfolios one quarter and think, okay, this is how it's going to be every quarter. Earnings beats is going to beat the S&P by 10 percentage points every quarter. And so that you jump into these portfolios, and then for whatever reason, maybe growth, as we've seen throughout much of 2021, growth stocks don't perform as well, especially small and mid cap. And as a result, the portfolios don't perform as well. I think it's important to step back and look at that big picture of where the stock market is likely going over the next 5 to 10 years and which areas of the market you believe are going to outperform. that is the theme that goes into the portfolio stock selection. Okay. So when you look at the stock market, I'm going to go back. Let's take a look at the S&P 500, because the S&P 500 has just been going up throughout the year. If you've been part of our portfolios, you know that it's been, I don't have the right stock charts count, so I can't show you the charts, but it's been an up and down year at best for our portfolios. We've had a couple of rough quarters, including the one we're in right now. I mean, we're trailing the S&P 500 pretty significantly across 3 of our 4 primary portfolios, our model, aggressive, and strong AD. Our income portfolio is actually hanging in pretty close to the S&P 500, but I would expect that when the market is more value oriented and not as much growth oriented, because those are the stocks are going to be a little bit more value oriented, and they're going to pay, dividends and so forth. So our income portfolio is going to be better. The model, aggressive, and strong AD portfolios are not going to perform well when growth stocks are not performing well, because they're growth oriented. That's our philosophy. It's at Earnings Beats. We want to be in growth over time. And that's why when you go into our portfolios and you look, I mean, if you scroll down, we have this history of success. And if you go in and you look right now, this quarter, and this is what I was talking about, you can see model, aggressive, and strong AD portfolios are all down, while the S&P 500 for the same time period is up. And you can see that's pretty significant underperformance. But if you look at when we started these portfolios and look at their since inception returns, and from a long-term perspective, this is what, a portfolio, one of our portfolio folks at Earnings Beats, I would be focusing much more on the long term, and just recognize that when the themes go against us, we're going to have bad quarters. And when you look at other growth-oriented investors, look at Kathy Wood over at ARK Funds, and look at how poorly the ARK Funds have done in 2021. We're really not much different. I mean, we do switch out stocks. So I know, Kathy Wood is just stuck by Tesla and Zoom and, some of these other companies that, Tesla's done all right, but you get to Zoom and Teladoc and some of these other companies that did great in 2020, and she's been riding them down in 2021. Those particular growth stocks have not worked. Not only have not worked, they've been horrible. But you can also look at something like, so let me show you the ARK funds. So the S&P, you can see, was going up nicely. Look at what the ARK funds have done since February. The ARK fund was up near 160 in February. It's 95 now. I can tell you our portfolios have not done anywhere near this bad. They're probably down. I haven't done an annual look, but I'm guessing that they're down for the year, but a much more steady decline. And actually, I think our aggressive portfolio actually did hit a new all-time high last quarter. So it hasn't been all bad, but it's been the theme that's been driving the market lower. If you look at the IBD, I mean, a lot of folks look at that Innovator IBD 50 fund, FFTY. It set a high in February. It didn't reach a new high, just like our aggressive fund did, our aggressive portfolio, back in the last quarter. But look at where we are. We're down since February. So once that inflation news kicked in, and there's been all this talk about higher inflation, not just talk. I mean, we're seeing it in the numbers as well. That has really had an impact in this year in growth stocks. But we focus on the quarter to quarter. So it's really hard to get away from the bigger picture. Now, I believe inflation is not a problem long term. I've been saying it all year, and I'm going to keep saying it. 2022, I believe, will be the year we see inflation peak and start to head lower. And when it heads lower, the FFTY, the Innovator IBD 50 fund, I think will just soar. The ARK funds, I think, will soar. The portfolios at Earnings Beats, I believe, will soar. But in this current environment where we are right now, that is what's driving the underperformance in the portfolios. So the question, will the small and mid cap stocks, and we have a number of those in our various portfolios, the question was, will they suffer as we go into 2022? Well, if growth stocks continue to suffer in general, and another way to look at this, by the way, is, let's see, I thought I had a relative chart. I mean, if you look at the Dow Jones US large cap growth versus the Dow Jones US large cap value, and let's put this on a line chart. And I know I've run over a little bit today. I'll try not to do that in future shows, but I really thought this was an important question, especially for those of you that are Earnings Beats members and, are wondering about the portfolios. I mean, obviously I would be as well. But what you should be thinking of in terms of these portfolios is that they're more growth oriented. So if you're somebody who is interested in having a component of your overall wealth in growth, I think our portfolios are a great place to park that money. Again, we're not registered investment advisors. I can't give you advice. We use the portfolios from an educational standpoint to show how you can outperform the stock market over time. And I think we've been fairly successful doing that. But taking it quarter by quarter, or even in this case, year by year, with what growth stocks have done, that is what is going to drive you crazy, I think, if you're looking at it. The problem is you're thinking long-term, or at least I hope you're thinking long-term with these portfolios, but then you're evaluating it on a short-term basis. And I think that's a mistake. Again, everyone has to decide if, whether you're holding ARC funds, whether you're holding the FFTY, or whether you're holding our portfolio stocks, you have to decide how much pain you're willing to take when growth stocks are out of favor. I can't make that decision for anyone except myself. But as you look at these relative strength, now, first of all, look at large cap growth versus large cap value. It's been doing great. So if you've got Apple, or you've got Microsoft, or you have Tesla, or you have Google, if you have these companies, you've held up very well in the market this year. Those growth stocks have escaped the selling that we've seen in most growth stocks. So just kind of look at this picture. Since June, growth stocks, large cap growth has been going up versus large cap value. Now let's switch this to mid cap. So now we're going to do mid cap growth versus mid cap value. So we went down. Here was that rally back into last quarter. But look at what we've done this quarter. Here was about when we picked the portfolios, November 19th, right about here. And you can see what's happened. Mid cap growth has been underperforming mid cap value, even though, remember, I showed you the mid cap index. Let me just pull that up again. So watch from here to here and look at what happened with the mid cap index. From here to here, it's about flat, but the rotation's been away from growth and into value. Now, if we go back and we do the same thing here, but we go to small caps, the bounce back over the summer was not nearly as strong. And right now we're at about a 7-month low in terms of growth versus value among small cap. So here we were back on November 19th. And now here we are on a relative basis. So, I mean, if you look at the performance of the portfolios, I would just say that as long as growth stocks remain under pressure, and most growth stocks are right now, I wouldn't have high expectations for the portfolios, and I wouldn't have high expectations for growth stocks in general. And I think this is probably going to go on for the beginning part of 2022. How long? I don't know, because the stock market, if all of a sudden inflation peaks in May or June, the stock market is not going to wait. Wall Street won't wait until May or June to start buying growth stocks. They'll be buying them long before we see the fundamentals turn. So that's why it's hard to say, is this going to be something that maybe goes on the first month in just in January? Is it something the first quarter? Are we just going to explode higher now? And we've already seen enough selling in these areas. That's the difficult part. And that was the problem throughout 2021, is trying to get that rotation correct. All right, I'm going to wrap up looking at 3 Large cap names that the first one here, Tesla, is in the news today. Now, I put this chart together before we opened today, but I can tell you Tesla was performing extremely well in pre-market. It was up like $70 this morning. They announced their deliveries for the fourth quarter, which were way ahead of expectations. They recorded almost 1 million deliveries in 2021 in total, which eclipsed their estimate. So I'm going to give you the updated chart now on Tesla to see what we're doing here. And you can see now Tesla is up $104 today. I have gone on record many times throughout the last year saying that if you put my fingers to the fire and you said, pick a stock and you got to hold it 10 years, who's it going to be? This is my pick right here, Tesla. I love this company. I would say up to maybe 2 years ago, I was concerned about Elon Musk. I thought he was just all over the place. I thought, just never quite knew. Talk about volatility. I mean, he was a volatile person. But I've grown to appreciate his brilliance over the last couple of years and what he's building at Tesla. And even when we were pulling back here, look at the AD line continuing to go higher. Wall Street, and this is another thing. I mean, this obviously was impacting our portfolios too. I mean, we had Tesla in one of our portfolios. November 19th, it was 1,200. December 19th, it was 900. Timing is everything. I mean, Tesla's been a great company, but if you're in it during that month, it looks like it's a horrible stock pick. Well, now all of a sudden it's back up and doing very well again. So Tesla, I would say, continues to be one of my favorite stocks, if not my favorite stock going forward. I think it's a lot like Apple was 10, 15 years ago. You just never, or Amazon maybe is even better case because Amazon never could make money. And that was one I just could never get behind. I think it was my CPA background. I just never could get behind Amazon because they just couldn't make any money. And Tesla, not only are they making money, but their rate of growth is astounding. And this whole electric vehicle market is only going to grow. And you have, in my opinion, the undisputed leader. Not only that, their battery technology, their solar work that they're doing. I mean, all of that. And I don't spend a whole lot of time talking about fundamentals. I look mostly at the technicals. And if you want to look at the technicals, I mean, you can see this thing is literally a rocket ship. And so every pullback becomes an opportunity in Tesla, in my opinion. So anyway, Tesla, I think, looks great going into the new year. And again, this is another large cap grower that seems to not be worried about anything, along with Apple, which is trying to break out to a new high as we speak. And also recently on its new, it didn't even make a new high in price. It's up challenging it, made a new high in the AD line though. And so Apple, another stock that appears to be under accumulation. Every time we get a pullback, stock comes rallying back. And so Apple looks good heading into the new year. And then you got Bank of America, which is in the financial area. I actually like Bank of America. Well, I like banks in general because I do think that with all the inflation talk, you got to believe interest rates are going to go up a little bit. I mean, they're up 7 basis points today. Normally, when they go up, it favors financials. I think we could easily see the 10-year Treasury yield back at 175 to challenge those recent highs. I believe we might even get up close to 2% in the first quarter. And if we do that, I think Bank of America and many of these other banks could do really well. All right, let's take a look. And I did run about 15 minutes over today. I apologize, but I will definitely cut back on that. I just had some things I wanted to talk about. I mean, look at last year and then really get into these portfolios. I try to talk about these portfolios as often as I can. They're not my primary focus because, again, when I think of the portfolios, I think buy and hold mentality. I think long term. I don't think, it's great. And, we even talk about our performance this quarter versus the S&P 500. I'm not even so sure that's a great idea because I think it lends the idea that we think we can beat the S&P every quarter. We try to, but if growth isn't working, that's going to be a major headwind for us because I'm not going to pick value-oriented stocks in all of our portfolios during a secular bull market when we could take off at any point to the upside. Again, longer term, I believe we're going a lot higher. I mean, a lot higher in the S&P. I think within a decade, we're going to see the S&P 12 to 15,000, and we're at 4,700 right now. So do I really want to think like that and each quarter be looking at value oriented stocks? That's why we're in the portfolios stocks that we are. And hopefully this has helped to explain why for 2021, they haven't been great performers. It's not us. I don't believe it's our stock picking. It's the theme. And when the theme reverts back to growth stocks, I expect our portfolios to do extremely well. Anyhow, getting off to a good start in 2022. The Dow Jones up 130, the S&P up 23, the NASDAQ up 113. Small caps, mid caps, you can see leading, especially small caps up 1% today. So that's good news. Volatility, though, with all this green, volatility index is up. That always makes me scratch my head. It's just one day, but it tells us, and this is one of those warning signs too. We still have a VIX that's up at 17. When I've done long-term studies of the VIX, anything above 17 is kind of like that critical level for me. This tells me the market is still extremely nervous. And if the market's nervous and we get bad news, that's what sets the market up for selling. So I believe going into 2022, we're going to see some more aftershocks from the pandemic. I don't think we're done with them. Maybe by the second half of the year, but you got to be careful going in the first half. Let me again just remind everybody that we are having Market Vision 2022 on Saturday. It will start at 8:45 Eastern, 8:45 a.m. Eastern. We'll have a quick, probably 15-minute introduction, recap of things that happened in 2021, and then we're going to get into it. Like I said, Bill Shelby, lead software engineer at Stock Charts, David Keller, host of the Final Bar and chief market strategist at Stock Charts, and Grayson Rose, vice president of operations at Stock Charts, all joining me for this Market Vision 2022 event. I know they're going to have some great information for you. I'm going to give you everything I can think of to help support what I believe is going to be a very volatile 2022. So I think, I'd love to see you all there. If you're not a member, a free trial will get you to the event. So if you go back here to our homepage at earningsbeats.com, right here, that green button, click on it, check out our services, sign up. I think you will be happy you did. It'll be a great event on Saturday. All right, that's it for me. Again, Happy New Year, everybody. I really apologize I didn't have those charts up at the beginning of the show. Haven't been doing this for a week. I thought I clicked on, when I go to click to share my screen, there are like 5 or 6 different screens. I picked the wrong one. So it just kind of kept showing you what you were seeing before, and that was my bad. Hopefully get it right starting tomorrow. The next show will be tomorrow morning over at Stock Charts TV, starting at 9 a.m. Eastern. So click on that at 9 a.m. and the show will automatically play. On Wednesday, of course, I'll be back here at Earnings Beats. So everybody have a great day. Want to wish everybody a prosperous new year. Stay healthy, and hopefully we'll have a really good market, especially in the second half. And maybe I'm wrong. Maybe the market will take off in the first half of the year. We'll see. I just feel like there are a lot of warning signs that we need to be paying attention to. All right. Listen, everybody, again, have a happy new year. Be back tomorrow over at Stock Charts TV. Happy trading.